Recently, billionaire investor Bill Ackman has disclosed a nearly 20% stake in Hertz stock. HTZ is the ticker, and this is interesting for a few reasons, one of which is that Hertz has gotten absolutely clobbered over the last 3 years. You can see the share price has declined by more than 70%. This follows even the rally, subsequent to Bill Ackman's disclosure. There has been a sell-off where it lost a good chunk of the gains following Bill Ackman's announcement that he's getting involved and interested in Hertz stock. Another reason why this is interesting is the potential cause for a short squeeze. You could see that CK Amarillo, this is a distressed debt investor or distressed debt related fund that previously invested in Hertz following their bankruptcy just a few years ago. They own around 59% of the company. Throw in some index investors like BlackRock, and you're around 65% of the shares that are accounted for just with those two players. So if you factor in Bill Ackman throwing in another 20%, now you're talking about 85% of the company tied up, leaving around 15%. And this is interesting because, if Ackman converts his derivatives, which includes a total return swap, into actual shares, that's equivalent to around 60 million shares that he would own. That leaves an available float of only 46 million shares versus shares that are currently short, or at least short as of the middle of April, being 62 million. So you do have that potential for a dramatic short squeeze from here, given these elements, because there's only around 307 million fully diluted shares around this price. And another aspect that Bill Ackman has disclosed is that he thinks with good, solid execution, Hertz could have around a $30 price target in the future. So we'll talk about what sort of math he's using to get there, whether or not I personally think it's achievable, my thoughts on Hertz, whether or not it passes my personal investment checklist. We're going to cover all that and more in this video. If you enjoy educational investment content, you're watching Unrivaled Investing, please make a point of hitting that thumbs up, hit that subscribe button. Let's dive right into understanding Hertz, what's going on here. So this is an interesting story because, $30 price target versus a current price around $6 might suggest, several 100% upside. That would suggest a 5x upside from here. So as we look at Hertz, that's sort of Bill Ackman's thesis, 5x potential upside. When you think about Hertz, they describe themselves as a global leader in car rentals. They're in 160 different countries, 11,000 plus locations, $9 billion in revenue, a fleet of 560,000 vehicles. So this is a global business. It's a big business. And you could see it's not just the Hertz brand. They also have dollar car rental, thrifty car rental. Really, Hertz is the main one, but they also do have international brands like Ace, FlexiCar, and Firefly. So there's a lot under the Hertz umbrella. Hertz is the main focus, and this is a global behemoth. 560,000 cars in their fleet. The key reasons why Bill Ackman likes the thesis is one is that it's an oligopoly, meaning that the marketplace is fairly concentrated with the top three players, Enterprise, Avis, and Hertz, representing around 95% of the market. This means that the industry should have some pricing discipline, and you can get attractive margins, attractive profitability in the future. While Enterprise is a private family-owned business, he believes the margins for Enterprise is north of 20%. So if you could have significant margin improvement with Hertz in the future, that is sort of the North Star. Maybe with solid operations, solid turnaround, it's currently nowhere near that. Maybe they could have close to 20% operating margins in the future. Another key aspect that Bill Ackman likes is the prospect that tariffs could actually make Hertz's vehicle fleet worth more, in the sense that used car prices could rise. And he talks about how with over 500,000 vehicles valued at approximately $12 billion, a 10% increase in used car prices could equate to around $1.2 billion gain on its auto assets. I mean, that's an interesting dynamic, especially because their market cap, Hertz's current market cap, is only around $1.8 billion. So a $1.2 billion gain on their auto assets is quite significant relative to the current price. So that is an interesting element. I think the crux of the thesis really comes down to this slide, however, which is based on management's, goals and building blocks of their strategy, which is one, to increase their revenue per unit per month. So currently their cars, the way to think about it is around $1,500 in revenue generation per month. Their goal is to get it over that. So currently it's around $1,400. The goal is to get it over $1,500. And the other goals are to manage their expenses. So increase revenue and manage their expenses, possibly getting their, let's say, their depreciation charge per vehicle under $300 per month, and getting their operating expenses also lower. So increase revenue, manage costs. That's really the goal here. And as we look at this, you can see management has pretty much disclosed this as well. And, one key aspect that impacted the results in 2024 was an investment in, electric vehicles, and they're trying to cycle out their higher cost vehicles and cut expenses. And you also have new management in place that's looking at this, for example, talking about selling tens of thousands of Teslas that they've made a bet on. So when we look at what Bill Ackman is calling out in terms of the potential for this $30 share price, he's effectively saying, yeah, look at what management's targeting, this $1,500 revenue per unit, looking at this $30 per day vehicle operating expense and $300 in depreciation per unit per month. And he thinks, yeah, if management can deliver on that and you're able to get a little bit better fleet utilization of people, effectively using the Hertz products more, then you could get profitability, adjusted profitability of around $2 billion. That's adjusted EBITDA of around $2 billion. And he thinks if you apply a 7.5 times multiple for that, so 7.5 times 2, you're talking around a $15 billion enterprise value, less around $5 billion in debt that they'd have. So $15 billion in enterprise value, less $5 billion in debt for non-vehicle debt. So this business is a little tricky because they do have a lot of assets, this $12 billion in vehicles, but there's a lot of debt tied to that, nearly, I think, $11 billion plus. So he's saying, don't worry about that, the vehicle and the vehicle debt. Focus on the enterprise, the Hertz enterprise itself. He thinks you can get $15 billion in terms of enterprise value there, less $5 billion in debt that's not vehicle related, that's tied to the Hertz enterprise. And now you're talking about a potential market cap for Hertz around $10 billion. $10 billion versus 300 million shares. That's how you're able to ballpark get what he's calling out a $30 per share target. Ballpark. This is what he thinks it, could happen with Hertz, within the next few years by 2029. This assumes management delivers on the building blocks that we were just talking about. So the question is, what's the path ahead for Hertz? Is it sort of going to be a dilapidated business that gets worn down, maybe goes into bankruptcy again, or does it have a bright future with lots of profitability? And so before diving into those two different paths, first of all, understand none of this is financial advice. And also, quick plug, just last week, Jasmer, a member of the Unrivaled Investing community, shared the following. This is a direct quote. "I've had a good run with Unrivaled and would recommend your service to anyone interested in investing." This follows Michael, who said, "So far, the subscription has paid for itself in 3 months. Looking forward to what the future holds. Me too, looking for more bargain shopping." And by the way, the prices for Unrivaled subscriptions will be going up at the end of this month. So now is the time to lock it in if you're looking for compelling ideas. That's unrivaledinvesting.com. Rates for the unrivaledinvesting.com subscription will not be lower in the future. This is as low as it's going to get. So looking at Hertz, the reason why Bill Ackman thinks, he's called out effectively, there's potentially 5-6x upside, huge upside. $30 price target, $6 price, hundreds of percent upside. That's what Bill Ackman thinks could happen with really solid execution, recognizing this brand has been around for 100 years, more than 100 years. But there's a reason why this opportunity exists, and I think it comes down to weak to terrible fundamentals. You can see revenue. Revenue declined 3%. They talk about how their rates declined while volume was relatively flat. That in of itself is a data point for investors to think about, because I doubt that the broader rental market actually shrunk in 2024. That would suggest, in my opinion, that Hertz has been losing market share, and various different data points suggest that they've been losing market share for years. That goes against the very premise of this channel. I'm looking for unrivaled companies that have the right to win more market share over time. So that alone is a red flag that's worth reflecting on. It's also worth understanding this means effectively that the every business has price and quantity, a price that you can charge and the quantity of units, or hours of a service. It's always some sort of price and quantity. And if you see an element where Hertz, in this case, is talking about a decline in rate, that's the price, while volume is flat, that effectively suggests that you're a bit of a price taker and more of a commodity type of business, which is also something that I don't like. I'd rather have a business where they say, oh yeah, each year prices go up a couple percent because we can. That's a beautiful type of business model. That is not what you see with Hertz. You see, folks say, what's the best rental car rate I can have, and they're shopping around between Hertz and Enterprise and Avis. Another key aspect that despite this decline, they actually had to expand their fleet, and they increased their fleet by 1%. So that is the example of an ugly type of business, is you have, effectively declining revenue and you're still having to invest in the business. I'd say even worse is the utilization. The usage of their fleet actually declined by about 1%. So this is one of the prior management's missteps. So they're looking to rectify this and get better utilization. And this is something Bill Ackman's also called out. Maybe this could go from, 80 to 85% over time. That's a key aspect, getting leverage on this business. Increased usage of their fleet has a big impact on the business. And then another example of why this is such a tough business is that you saw a 4% increase in effectively their transaction costs or their operating costs last year, in part driven by insurance costs, talking about insurance headwinds. So you have, effectively a price taker given dynamic in terms of revenue, and then cost inputs that they can't control as well. Now they are looking to manage their vehicle costs, as I already called out, swapping out some EVs for ICE vehicles or internal combustion engine. But overall, this is, a very tough picture, and it translates into huge losses in 2024 and huge cash burn, nearly $2 billion in cash burn last year. So this is, frankly, a very ugly fundamental picture. And this is why the setup exists. So Bill Ackman is betting on a turnaround in multiple variables, the better costs and better revenue over time. And his view goes back to that marketplace, that there's three competitors. They can behave rationally so that they can all get those, reasonable or attractive return on capital over time. That's, I think, the heart of the thesis, because right now, looking at these results, that's not what you're seeing. This is a company, just based on these results, roll this forward, and you would have a company that would be in Chapter 22 or bankruptcy again. That's the joke. Versus Chapter 11, Chapter 22. Another key aspect that, investors, myself, really don't like to see is the fact is that, yes, in addition to their vehicle debt, ignore that for a second, they have a lot of debt tied to Hertz themselves that's going to be due. And that's around $5 billion. And you have, $500 million plus due in 2026, so next year. Then in 2028, you have another couple of $1 billion, 1.2 plus another, $800 million. And then 2029, you have what seems to be the remainder. So another couple of $1 billion. So that's a lot of debt. And so if they have any sort of economic hiccup, or if you have some sort of impact in tourism, let's say in the United States, that impacts Hertz demand, that could come at a terrible time. Maybe you have a recession as well and travel goes down. You have that dynamic combined with this debt schedule that could create even more heartburn for Hertz shareholders in the future. So those are real legitimate blow-up risks, in my opinion, to be aware of. So as I think about, Hertz relative to my investment checklist, thinking about aligned management, I think you have aligned owners, where you could say that the top three owners, really top two owners, you're talking about, 80% of the shares. So if the stock isn't delivering, they will swap in management that delivers. That said, I ultimately prefer the founder, sort of skin in the game dynamic, because when you have the founder, they're working on the business in a different capacity. It's not a hired gun. It's, this is my baby, and why is it going to be so much bigger in the future, and what are the long-term investments that I'm going to be making today to make sure the wealth is built over the long term versus, let's say, just delivering on a target in the next couple of years. So I'd say give it a pass for aligned management. Compelling valuation, I'd say maybe if you see a turnaround in the results and you get to that $2 billion in EBITDA. I think, frankly, that turnaround figure is going to be very, very tough to achieve. This is not an easy business, and their financials were nowhere near that in 2024. It'll require multiple variables in terms of cost management and better revenue, better demand to get to that $2 billion that Bill Ackman was talking about. That's not even profitability. That's just an estimate of adjusted EBITDA. So, and then he throws a multiple on that. So I'm not crazy about the valuation, but I can understand why it's compelling, why you could say, hey, maybe there's 5x upside type of situation. Obvious growth potential, that one's even harder, especially because Hertz has been losing market share. So I would say it fails this one. From a blow-up risk perspective, you have sizable debt, you have poor operations so far, you have this risk that the turnaround doesn't work out. So I would say it's already now failed 2 of these items. And so at this point, I'd say Hertz just really isn't appropriate for my own personal investment journey, even though smart, shrewd billionaire investors like Bill Ackman clearly like the risk reward. And I can understand, generally, if you're making bets with 5x upside and let's say 100% downside, over time, those types of bets could work if, let's say, the odds are 50-50. Because 5x is a better payout than 100% loss. That said, I look at Hertz and it's just too hard for me. It doesn't pass my checklist. I would rather find those, businesses with more repeatable revenue, lower capital intensity, and better alignment. I'd say you could probably pass on that. I think just easier stories. And I think there are much easier stories, less dependent on the economic cycle. And so I think there are better stories out there. I call them out to my subscribers at Unrivaled Investing. But it is interesting to see Bill Ackman making this sizable bet, effectively saying, hey, he's interested. He's acquired 20% of Hertz through both the shares and the options. Frankly, wouldn't be impossible for him to consider some sort of complete acquisition based on the current valuation. If you think about the current price and the fact that there's the float is only around 15-20%, and he already bought 20%. So I just don't think he wants to, just given the risks and dynamics of this business. So I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.